Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow, and today's guest is Fernando Angelucci, and Fernando has quite a bit of a portfolio. By age 30, Fernando has built a portfolio of over 200 million in self-storage assets across the country within the last 4 years. Fernando has diversified his investments between purchasing existing cash flowing assets and building from the ground up Class A REIT graded facilities, utilizing adaptive reuse conversions of big box retail stores into premium self-storage. In addition to owning his own acquisitions, Fernando provides other self-storage investors access to off-market facilities at drastic discounts, capital for strategic partners, and opportunities for passive investors to participate in self-storage syndication. So, Fernando, welcome to the show.
Yeah, thanks for having me, Gabe.
Yeah. I'm interested to hear about everything that you've got going on, and I think that's a really great concept with converting the big box stores. I've seen some folks doing that, and it's always been an interest. So I can't wait to dig into that. But really, before we start there, why don't we start with how you got into real estate?
Yeah, some son of two immigrants, so kind of had the old school American dream kind of pushed on me. That all changed when I read Rich Dad, Poor Dad when I was 16. Mm-hmm. Then from there, I realized I wanted to be a business owner. And then later on, realized I wanted to be a real estate business owner. From there, went to school, graduated with an engineering degree, but only lasted about 13 months in the 9-to-5 world, and started with flipping residential contracts or assignments, then houses, and then buying them and holding them for rental, and then upgrading to multifamily, doing the same thing. And then after a few years of doing that, around 2016, two things made me switch into the self-storage world. The first was that I thought there was a crash coming in the real estate space. Obviously I was wrong. Should have held out for a little bit longer on those assets. And the second piece was I started to see more and more legislation being pushed and sweeping across the country that were making it much more difficult to be a landlord, more tenant-friendly laws, right? So, rent restrictions, basically the government coming in and telling you what you can do with your private investment. I mean, we saw that happen during the pandemic to a pretty massive detriment. So I started selling off all of our habitation-based real estate from 2016 to 2018. And then 2018 is when I bought my first self-storage facility.
Okay. And as far as the first one that you ended up buying, give me a little bit of an idea as to what it was, how many units, kind of location-wise?
Yeah, so it was a Class C facility, completely unmanned, no office, no fencing, no utilities, nothing. It was behind a Dunkin' Donuts. This was in a town called Yorkville, Illinois, just outside of Chicago, maybe 2.5 hour drive from the kind of city center. And it was just shy of 17,000 net rentable square feet. I think it was 130 something units. We typically don't talk in terms of unit number, more in net rentable, because you can have, a facility that has 100 units that are all 5x5 units, or you can have a facility that has 100 units that are all 20x40, and those are drastically valued differently.
Sure. Yeah.
About 17,000 net rentable feet. And we bought it about a 7% cap rate, 100% occupied, and then just started raising rents, dropping expenses, and then expanding the facility as we went along.
Okay. And did you do that one with a group of partners, or did you do that as a syndication, or what did that look like?
Yeah, exactly. So, a group of partners, my business partner, Steven, we've done basically everything together. We brought in a couple other investors that we've worked with in the past, and that was our very first deal.
Okay. And from there, it obviously continued to grow. You don't get to $200 million by not growing and being aggressive, especially in 4-year time frame. So give me a little sense as to what, how did you grow quite that fast? Obviously, that's just huge. So tell us a little bit about how you did it.
Yeah. So one of the things I always notice when you meet new investors is that they treat being a real estate investor more as a hobby and not as a real business. So we read a book, the company collectively read a book called Traction by Gino Wickman, which teaches you how to run your company on a, entrepreneur's operating system is what they call it. So start with 10-year goals, and then you back down to a, 3-year target, a 1-year picture. And then from there you have, 90-day rocks is what they're called. And then to get to those 90-day goals, you have a weekly scorecard that everyone is accountable to. And then you can further break it down into daily tasks for, more entry level positions. And from there, we know exactly what we have to do every day to hit our 10-year goal. So that was the first part in helping scale the company. But the second piece, which was something that we decided to tackle pretty aggressively, is that eventually, it doesn't matter who you are, eventually you're going to run out of money, and eventually you're going to run out of money, your friends' money and your family's money, and you're going to have to learn how to raise capital professionally, right? So we focused a lot on our marketing strategy and really treating our company more as a marketing company than a real estate company on both sides, on the, the deal flow for the actual assets themselves, but then also for capital flows as well, making sure that we're being professional capital raisers, getting the right circles, paying the right people to go out and raise capital for the projects. We had some very aggressive growth goals. We want to basically own anywhere between 95 to 115 Class A assets by the end of our 10-year goal, and then sell out to a publicly traded real estate investment trust. That would put us at around, in today's dollars, about $1 billion valuation. So that's always been the goal from the beginning, and that's how we started. So once you figure out the goals and how you're going to get there, then you need to staff the right people so that you can grow and accomplish those.
Yeah, that's. I think that's a very smart way to do it, and you already know, from day one, kind of what needs to happen. So, and how about your? So you have a partner. Did your partner, was he already in some of this as far as real estate, or were you guys both just kind of started it together?
Yeah. So I met Steven freshman year of college at University of Illinois. He was a random assigned roommate. And from there, we just, I've always read and wanted to do real estate because of just being exposed to Robert Kiyosaki's books when I was younger. So all throughout college, I'd be reading these books and going to seminars. And he always thought that was pretty cool and took an interest. But after we graduated, we kind of went on 2 different paths. So I had my ag bioengineering degree. I went to go work for a Fortune 50 company. He had a marketing advertising degree. And then he went to go work in the city of Chicago. And so when he loves when I tell a story. So when I finally decided to quit Dow Chemical, I started wholesaling houses. And, as you do with your good friends, your best friends, you kind of poke them a little bit. So every time I'd go to a closing, I would refuse the closer to wire me the funds. I wanted them to cut me a check right there so I could take a picture of it and text it to Steven and say, how much did you make today? Because here's how much I made.
Nice.
After about doing 6 months of that, he finally got fed up. He said, you either got to stop sending me these photos or you got to teach me what you're doing in real estate. And the rest is history from there. Yeah.
Oh, that's awesome. That's awesome. Fantastic. How long did you say you did the wholesaling before you switched over to self-storage? I guess you went from there to multifamily and then self-storage.
Yeah. So you got to realize that, wholesaling isn't an asset class. It's just a tool, the tool belt to monetize your leads, right? So a lead comes in, doesn't matter what the asset is. And you can either, you can say pass because it's not a good deal for anybody. You can buy it yourself to flip it. You can buy it yourself to do a buy and hold, or you can wholesale it off if it doesn't meet your criteria, but it meets somebody else's. So we still wholesale today. We're just wholesaling storage units now. As opposed to, say, single family homes. So like I said, we like to treat our company like a marketing company because we realize that if you control the deal flow, that deal of a lifetime, I'm using air quotes for your listeners that aren't watching us, that deal of a lifetime comes around every 3 to 6 months if you're just doing enough marketing, right? So we're looking at typically 20 opportunities a week. We have a pretty strict, we usually will buy, one in every 200, one in every 300 deals that come across our desk, but we'll wholesale others at a much higher degree. I mean, last year alone, we probably pulled $6 million in wholesale fees just on storage facilities. And that's in addition to, flipping the facilities, building them, or doing the buy and hold strategy.
Fantastic. What does the marketing look like on that then? And where all geographically are, you focused?
Yeah. So, we do, instead of having like a marketing strategy, we have a marketing platform. So what we ended up doing was realizing that to educate your market is how you dominate the market, right? So we go out and, unlike, say, the gurus that make you pay to learn about how to invest in whatever asset class, we give out all that information for free, knowing that eventually someone's going to come across a deal that's either too big for them or doesn't hit their criteria the right way, but may hit ours. And then they start sending us deals. So now almost 35 to 40% of the deal flow that comes across our table, we don't even pay for at all. It comes from referrals from people that have heard us on, I've been on over 100 podcasts. We speak at all the largest industry trade shows. We do a lot of outreach. Our social medias are, constantly filled with, how to do self-storage, how to, we're basically teaching the people to go out and find us deals. And, if somebody happens to do a deal on their own, great. We don't need to do all the deals in the world. We just need to get to 95 to about 115 of the ones that we're going to keep long-term to sell when there's, roughly 70,000 self-storage facilities in the US alone. So it's more of a platform. And then to your second question about geography, we're kind of geography agnostic in, how do I describe this? So every one of our deals goes through a 3-tiered underwriting structure. And when it comes on the other side of that 3-tiered underwriting, it's either a yes, we're going to buy it, or no, we're going to buy it, or we're not going to buy it. So what we've noticed is that deals in the Southeast pencil a lot better. I have, for example, I'm not saying that I wouldn't do a deal in California, but of every deal we've ever underwritten in California, none of them have ever penciled out from a cash flow perspective. So we just don't do them. But that doesn't mean that if somebody brings us a deal from California, we're just going to turn away point blank. We're still going to run it through our underwriting gauntlet. And if the numbers make sense, they make sense. If they don't, they don't. So typically what we're looking for is neutral to, well, it depends on the verticals, right? So we have basically 3.5 or 4 verticals of how we do this business. One is we buy existing cash flowing facilities from mom and pop operators. These are typically smaller. They're typically in Class B, Class C markets, more secondary, tertiary type stuff. And there's the ability to raise rents, drop expenses, and then pool those assets into larger portfolios. For example, last year we just sold off 10 to 12 of our facilities in a one portfolio structure. These were all of those kind of Class C, more rural, tertiary type facilities. So for those type of facilities, all I need to see is that the competition is getting close to saturated. There is the ability to raise NOI pretty significantly over the next 24 months, and it would fit into a regional portfolio that we already have existing. Then you go to the other side of the spectrum for our second kind of vertical, and that's the one that we're trying to beef up our net rentable square footage inside of the portfolio. So those mom and pop deals are typically very small, anywhere between 10 to 30,000 net rentable square feet, which could be like 100 to 300 units if you want to talk the average unit size.
Yeah.
We wanted to get to this 8 million net rentable square foot mark as fast as possible. And when we started making offers on larger facilities above 50, 60,000 net rentable, all of a sudden we realized that the cap rates were literally getting chopped in half. And it's because we realized now that we're competing against publicly traded companies for those assets, and they have much cheaper cost of capital than we do. So it kept getting beat. So I found out, okay, if instead of buying these larger assets at a 4.5% or a 5% cap rate, I can build them at an 8 or a 9% cap rate internally. So that's where we started building these Class A, REIT grade institutional style assets. So for those types of deals, we're very concerned with the geography and the demographics because there's no operating history, right? We're buying land and then we're building. So that means all the competitors need to be basically 100% full with a wait list. They're stabilized with a wait list, I should say, because in our industry, we never want our occupancy to go to above 90% because that means that we're not charging enough on a per square foot basis. So as soon as it gets up to 92 or 93%, we jack up rates, right? I'm looking for areas that have extremely high population growth. So the places that ends up penciling out are like the Southeast, Carolinas, Tennessee, Georgia, Central Florida. We're really big on right now between the Tampa and Orlando corridor. We have close to $140 million of development under contract right now in that corridor, that I-4 corridor. And then you have kind of our third real vertical, which is those adaptive reuse conversions. And I'm sure we can talk more on this subject later on in the podcast. But those ones we started doing because when COVID hit, all of a sudden we started having these supply chain disruptions where we couldn't get materials in time for the build. Some materials were 18 months out, 20 months out. It's ridiculous. And then if you could get the material, the pricing volatility was through the roof. I mean, in a 6-month period, steel went up 500%. So that destroyed a lot of potential deals for people around the country because they just didn't underwrite. When you stress test a deal, you don't stress test materials up to 500% increase, right? So that was kind of like a weird situation. So then we started for those ones. We're typically looking for big box retail stores that are in mall locations, basically. So Sears buildings, Walmarts, Kmarts, Circuit Cities, those type of things. Mm-hmm. And we want them to be kind of on, where malls do well, right? So high traffic counts, very high median incomes in the area, dense residential housing all around. That's kind of what we're looking for on, those adaptive reuse. And again, those are more, as opposed to an existing facility, we're a little bit more pressured on the demographics and the geography because, again, there's no existing history of how that operated. So we have to look at all the competitors. We got to make sure there's demand there that will be able to absorb, 600 to 800 units coming online all at once, right?
Yeah. Yeah.
And then, of course, that little half or that fourth avenue is the wholesale side of things that we do.
Okay. So two of the verticals you described really are, building to some extent, right? So you're having to, how long does it take to, obviously it's going to vary depending on the size, but how long does it generally take where it starts to cash flow, that kind of thing? If, on say the ground up ones or even these, conversions?
Yeah, so I'll tackle the ground up first, and then I'll explain the conversions, because that's one of the main reasons we started switching to doing some conversions as well. So on a ground up facility, we're typically building anywhere between a 92 and 110,000 square foot building or buildings. That nets down, because you lose obviously square footage, to hallways and offices, bathrooms, stuff like that, mechanicals. So that will net down anywhere to like 69 to 80,000 net rentable square feet. That's usually going to take me about 12 months to build, 10 months, but I had 2 months of buffer. So 12 months to build those. Then you're looking at another 24 months for that thing to get up to either break even on a cash flow standpoint or stabilization at 90% occupancy, depending on your markets, right? So we have some markets where these facilities are leasing up 15% a month, which is crazy. It's a really high velocity versus, when we're buying stuff in the Midwest, not near a large city, we're usually assuming that lease up is going to be 2.5% a month, right? So huge difference there. So let's just assume it's the Central Florida ones that we're building. So leasing up anywhere between 6 to 15% a month. That means that these things can start making distributions to our investors typically in month like 24 to 36. We're already starting to make our quarterly distributions to our investors.
Wow, it's a very interesting. And is there a difference in time frame on the conversions?
Correct. Yeah. So because when we're buying a conversion opportunity, we're essentially walls in already, right? So we have a roof, we have facade, it's already good to go. So that drops that 10 to 12 month building timeline down to 6 to 8 months, which is huge, especially now that interest rates are double what they were before. Some of these deals, I'm spending $100K a month in P&I payments. So if I can cut off 6 months and already start collecting cash flow that much faster, it's a huge bump in return to the investors. So it's kind of the play, though. It's, you have these Class A ground up ones in really good, really hot markets. But to find the adaptive reuse deals, you have to go into markets that aren't so hot that they're still being leased out, right? I need to go to markets where you're kind of on the edge of a B and an A market so that there is some vacant, prime real estate that I can purchase at, pennies on the dollar. And so that's another piece that I want to talk to you about. It's, on the ground up developments, the Class A stuff, I could be all in for anywhere between 125 to 140 bucks a foot. That includes everything: soft costs, hard costs, interest and operating reserve, acquisition and financing costs, the whole gambit, right? Land. On one of these adaptive reuse deals, because I'm getting such a deal on the actual structure itself and also dropping the amount of time I need to have interest and operating reserve because we're getting that much faster to cash flow, I'm usually able to build those for like 80 to 90 bucks a foot. So shaving, 20, 25% off of the total project cost per foot on those types of structures.
Wow, that's very interesting. And so tell me on those, so obviously on the ones that you're building from the ground up, you're buying the land. Are you buying the land on like the ones you mentioned mall properties? Are you actually buying the land, or is it are you leasing the space?
Yeah, so I am someone that likes to mitigate downside risk, and a huge downside risk if I build out all of this infrastructure and all of a sudden the landlord's like, hey, I'm doubling your lease payments.
Right.
That's a huge risk for us. So we will only do deals where we own the asset in its entirety. Yeah, we don't do any type of land lease deals whatsoever. So that's one of the reasons why we can't go into Hawaii, right? So in Hawaii, any type of commercial properties, every one of them is on a 99-year land lease. It's almost impossible to buy assets out there.
Right. Okay. That's very interesting. And what about, what is the exit strategy on these when it comes to your investors? I mean, you mentioned X amount of time. If you're doing from the ground up, it could be as much as 36 months before you start to do distributions. Is the refinance kind of a goal? I guess right now, obviously with rates, that might be difficult. Tell me a little bit about kind of what your game plan is.
So the refis are actually not difficult at all, because of the low cost to develop these compared to their stabilized costs. We're typically, when we're ready to go to a refi, we're at like sub 50% loan to value. We're in the 46 to 49% range. So getting a 65% LTV refi, I'm pulling all of my money out plus distributions,
Yeah.
But so, I think let's step back, and it's more of a conversation on types of investors and investor profiles, right? So the investor that's willing to take the risk on a non-cash flowing asset that you have to build, basically bring it out of the ground, is different than the type of investor that just wants to clip coupons from a stabilized asset, right? And some people have a little bit of both, but for the most part, that's not how our capital works. So what we'll find is that there's always two stages of a deal. There's the investors that want that super high return for the risk that they're taking. And then once that facility becomes stabilized, they have either the option to stay into the deal once it gets refinanced, or take their money and roll it into the next development deal. And then, so what we'll do is we'll take call it a development vehicle or opportunistic style fund or vehicle. And then we'll literally sell those assets into an income fund or income vehicle that can be structured in many ways. It could be a DST. It could be just a true income fund. And then the investor on the front end could say, hey, I want to go over to the income fund and just collect, coupons like you would with any type of fixed income asset, or let's roll it into new development. So because our goal is to have an exit to an institutional partner in the next 10 years, most investors, syndicators, don't want to be in deals for 10 years because they want that high velocity of capital, that turnover. So that's why we have this kind of structure where once the asset becomes a core or core plus asset, now it's a different type of investor that just wants to, get their coupon, return and just set and forget it type thing.
Yeah. What about the returns? I know obviously, there's no guarantees, but what kind of returns have you guys been able to provide the investors? And is there a difference between the two that you just described?
Yeah. So, I think the economy and interest rates, that will always change the way these types of returns will work out. So I can tell you what we targeted, and then I can tell you what we were getting before interest rates went up, and then what we're getting after interest rates were up, right? So
That's fair.
We're typically, to be competitive in the market, everyone uses internal rate of return because then you can compare apples to oranges, right? You can compare a single family fix and flip deal to a ground up developed self-storage deal because it's all IRR driven. So on anything that usually involves construction that has no, distributions of cash flow for a couple of years, you're going to need to be in that high teens, low 20% internal rate of return to get that thing funded in a reasonable amount of time from our investor base, right? When it's more of a cash flow value add turnaround type of project where we're walking in, it's already 100% occupied and there's just room to maybe raise some rents or drop some expenses that are superfluous, then you're looking at more of like a 14 to 16% internal rate of return. So that's what we always target. Now, prior to rates doubling, there was a lot of easy money out in the market, and there were people willing to buy assets on a 5-year return on cost, right? So not even a 5% cap rate, but a 5% cap rate 3 years or 5 years after they bought it. So return on cost equation. So that's just crazy, right? And I would never do that, but I'm willing to sell to those types of people. So here's a perfect example. We had a deal in Mokina, Illinois. It was southern suburbs of Chicago. We told our investors that we would build it. All in cost would be about $12.7 million. And then 5 years from the day we raised the capital, we would look to exit at about $17.7 million, right? So that would equate to, I think on that one, that we were pushing like an 18 to a 19% internal rate of return was our target. Well, we built it, and in month 13, somebody offered us $18 million for a facility that had no occupancy. It was brand new, right? So we said, okay, let's take it. So obviously the internal rate of return jumped to like triple digits on that one. I think it was like 112 or 116%. But that's not normal, right? We were living in a world that had 0% interest rates for basically 10 years. So people were chasing yield and were willing to take risks to get that yield. Nowadays, you don't see any of those, or very rarely will you see those certificate of occupancy purchases that are basically the value of a stabilized asset. So we're not seeing those types of returns anymore. But I mean, we've exited a portfolio recently. Some of the individual properties in that portfolio were as high as 133% internal rate of return. Some of them were as low as like 24, 25% internal rate of return. But again, that's not what we target. We always target, I'm an engineer by training, so I'm always thinking worst case scenario. And the worst case scenario is taking the entire asset to full term, right? We typically set up our syndications as 5-year exits.
Okay. Interesting. And so, and a lot of these deals that are coming across your desk are from the education stuff that you're doing. Do you do anything with brokers on existing stuff, or going directly to mom and pops, or how does that?
Yeah, so we very rarely will buy with brokers because we want to be the only one negotiating at the table, right?
Yeah.
But we will always sell with brokers because we want as many eyes on our stabilized asset as possible. And that usually will equate a higher price than what you would get if you were trying to save the commission that you'd have to pay by going off market. Correct.
Okay.
So, we have a lot of direct to seller marketing channels in addition to all the referrals that we get from, other podcasters and your listeners and people that follow our social media and all that stuff. And those are usually mix of things. So driving for dollars is one, where we'll have employees physically drive facilities in their local markets and stop in and just say, hey, my name's so-and-so, I'm with Triple SE. We'd love to make an offer on your facility if you're ever getting ready to sell. And the interesting shift between leaving the habitation-based space and getting into the self-storage space is that everything in the transaction really slows down. When I was doing single-family homes, from the day I called them to the day I closed on the house was like 30 days or less, right? They had cash in their hands in 30 days. But in self-storage, very rarely do you ever find distress at all because they're all cash cows. I mean, on an unleveraged basis, your expense ratio is like 30 to 35%. So if you're 35+% occupied, like you're already making positive income, So with those situations, it's more of like a long-term, like value proposition. Hey, have you ever thought about selling in a 1031 or with another one of these structures that can help you defer capital gains? Oh, you don't know about those? Let me connect you with our tax people. They can work with your CPA to show you how to structure this in a way that you don't have to pay any capital gains. Or, hey, I understand you're not ready to sell right now, but over the next 4 years, and I'm using that word because that's the longest follow-up we've had on a couple of deals that we bought was literally, we started talking to them 4 years ago. I noticed that your occupancy is pretty stagnant and you don't want to sell unless you get this price that we're not unwilling to pay right now based on your, previous 12 months P&Ls. How about I show you how to increase your NOI so that come 12 months from now, I'm ready to pay you that price that you're asking for because now you're facilitating. So we're showing them, instead of just being just another buyer that's hounding them and telling them they have to take our price, we're there to truly add value and educate our sellers so that if and when they decide to sell, we're going to be the very first person they call because we weren't just hounding them. We're truly providing value in order to get that relationship and to get to that transaction. Yeah,
that's great. I think that's tremendous. I mean, that kind of locks you in with them as well and really differentiates you between, the other folks that are out there. So there's driving for dollars, cold calling. We used to do text messaging, but now with the new TCPA laws, we just don't want to get into that space. Other than that, I mean, we'll meet people at trade shows. So every year we speak at the largest self-storage conference in the world. It's called the Inside Self-Storage World Expo. So we're typically on stage. Typically you have a bunch of self-storage owners there because they want to learn more about what's going on in the industry. And then, we always tell them that, hey, if you're ever willing to sell, our hands up because we're willing to buy. There's also the state association. So just like how you can go to a RIA group
as a real estate investor. You can also go to self-storage association groups, both at the state level, but then also at the national level. So that's another area that we'll find, direct to seller opportunities. And then we get super creative as well on how we structure things. So not only are we willing to just buy you out completely, we're also willing to do some type of seller finance structure to help you with your capital gains, break those payments up over time. We're even able to do equity partnerships or joint ventures with sellers, which we found that not a lot of people do. So I'll say, hey, Mr. Seller, I'd love to give you the price you want for your land. I'm unable to pay you that much because it's just above market value. But if you're willing to come into a joint venture and give us your land as your equity contribution in exchange for shares of this joint venture or your existing property that we're going to, expand upon, I'll be able to get you your price and a return above that because now you're also an investor in the joint venture as well. And that has helped quite a bit. Okay. Especially in the environment we are now where you have to get really creative on rate and terms.
Okay. How about insurance cost? I know, in talking with folks, there's been a lot, especially down in like the Florida area, but any of the coastal areas right now, they've seen some big increases. But I'm not sure how that equates to, self-storage. Are you all seeing that as well?
Yeah. So we're seeing a little bit of increase in storage. It's more for like the Tornado Alley areas. Right. And the reason for that is because once you understand fundamentally how self-storage works, you realize from an insurer's point of view, there's not a lot of liability to you as the insurer, because everyone at every one of our facilities, they have to give us proof that they have renter's insurance on their possessions. And if they're unable to do that in our leases, our month-to-month leases, it states that you are not allowed to store anything over a certain value. And depending on where we are, that can be $5,000, that can be $2,000, that can be $1,000. So that limits our liability on top of the renter's insurance that they are required to carry to be a tenant or to be a customer at our facility. So that shifts a lot of liability away from the insurers, and we're able to then get lower rates. And the easiest way that we found this out is you can always tell when someone is in the self-storage insurance game or not, because if we'll see some crazy prices because they're, some big company that does everything like Allstate or State Farm or whatever. But then you go to these self-storage specific insurance companies like Bader, and the rates are literally half of what these one size fits all companies do, as opposed to a company that specializes in storage and knows how much the liability is reduced. As far as the coastal areas go, we typically won't build in areas that have, 100-year flood or higher. So that basically takes us out of all the Hurricane Alley type areas. So when I say Central Florida, I mean Central Florida, not only from like a north-south, but also from an east-west perspective as well.
Okay. Sounds good. What about as far as self-storage itself? Obviously, you've done some other asset classes, but what about self-storage really, is appealing to you? And have you seen changes since you've been in it? And where do you see it going?
Yeah, so we probably don't have enough time on this podcast to go through all the reasons. So I'll list 9 reasons, and you tell me which ones you want to expand upon. Okay, so sure. Highest return over the last 40 years, recession resilience, better leverage than other assets, easier management than other assets, fragmented market compared to other assets, very low break-even occupancies, no evictions, a high sticky factor, and then up to 20 ancillary profit centers that you can add on to one facility. Which one do you want to talk about?
Yeah. Let's talk about the returns. Okay. Highest returns over time. Yeah.
So there's a group called the National Association of Real Estate Investment Trusts, and they put out a report every couple of years on each REIT sector and how they do. So if you looked at the last 35 to 40 years, roughly, during that time, the S&P 500 has returned 7.5%. Multifamily has returned on average an annual return of roughly 13%. And self-storage has been at 17.5%. So that, 4% over habitation-based real estate may not seem like a lot, but you got to realize that's compounding. So at the beginning of this study period, if you had $100,000 to invest, if you put it in the S&P 500, you'd have about $500,000. If you put it into apartment buildings or residential housing, you'd have about 1.8 million. If you put it into self-storage, you'd have $4.1 million. So over double the return because of that extra 4% compounding, right?
Wow.
Now, most people say like, okay, if it's got a high return, that must mean that it has high risk. And what we've realized is that that's not true. Self-storage has asymmetric risk return profiles. So let's just look at recessions. Okay. So let's go back to the 0709, which a lot of real estate investors still, have like that burning hole etched in their mind from that time. So during 2007 to 2009, again, another study done by National Association of REITs. During that time, the S&P 500 dropped 22%. Multifamily and single family, there was a lot of investors and large companies completely going out of business. So 100% loss, right? Self-storage on average was dropping about 3.5 to 3.8% during that 07 to 09 period. So very recession resilient. But then let's fast forward to something that's a little bit more present in our mind, and that's the pandemic. So according to TREP, which is a commercial mortgage-backed securities research firm, of the 1,700 CMBS loans that were made to self-storage investors in the first 3 quarters after the country shut down, only 3 were more than 30 days delinquent. So that's a 0.17% delinquency rate. During that same time, multifamily was defaulting at a rate of 1,800% higher, or 18 times the default rate of self-storage. And that's, like I said, one of the things that we were talking about at the beginning of the podcast was, the government came out and they made some statements, and what renters heard, even though it wasn't what they were actually saying, what renters heard was, I don't have to pay rent because you can't evict me. Right. Yeah. So I know a lot of multifamily companies that completely went out of business, and now they're unable to refinance those assets that aren't performing well because the leverage they started with was super high, and now you have double rates and leverage has dropped 10 to 15% on refinances basis. 2021, for example, was the best year on record for self-storage investors. There was an average rent increase of 6.7% month over month for 12 months straight. We had some assets that the rental income increased by 80 to 100% in 1 year.
Wow, that's incredible. You mentioned one of the other points of being sticky. What does that look like from when somebody puts their stuff in a place, on average, how long do they stay? And
yeah, absolutely. So it's a bell curve, just like anything else. On the very low end, you have guys and gals will stay 2 to 4 months because they're putting their stuff in a unit during summer break while they're at school. And then on the other side, we have tenants that have stayed decades, 1, 2, 3 decades long at a facility. And so the reason for that, I think, is the actual dollar amount versus the percent increases in revenue. So for example, let's say I have a $150 unit per month, a 10 by 10, whatever. If I increase the rent on that $150 unit by $20, typically that is not worth the $500+ cost to move to a different facility to save that $20, right?
Yeah.
You got to rent a U-Haul. You have to take time off work. You have to bribe some friends with a case of beer to help you move stuff, or hire movers, professional movers, if you're moving a lot of stuff. But that $20 is a 13% increase to the bottom line, right? Mm-hmm. Now let's look at, let's say, a cheap apartment. Let's say you have a 1 or 2 bedroom that is renting for $1,500 a month, and you decide to do the same thing that I just did and increase the rent by 13%. That's a $195 monthly increase in rent. Do you think someone's going to go and shop? It's worth their time to go shop for a new place and go through the hassle of moving to save $200 a month? Absolutely. Yeah. Right. But in percentage terms, I just increased my bottom line by 13% by just increasing a facility by $20.
Wow. And as far as we're getting a little long on time, so I don't want to ask too many more questions. But I mean, I haven't even really scratched the surface yet. There's just so much, and you're very knowledgeable. Yeah. And so what when it comes to like existing facilities that you buy that are already cash flowing, what are some of the things that you find? Is it just mismanagement, or is there new technologies that can be applied, or where you get some of the levers that you can pull for some of the biggest return?
Yeah, it's all of above, right? So here's what we typically do when we go into an existing facility. Typically, it's run by a mom and pop operator. 50% of the time, they are their own manager. So they're sitting behind the desk as opposed to being a true owner. And what you'll notice is a lot of those guys and gals don't do market research. So they, I always joke that sometimes there's a policy of whatever your rate was when you moved in 10 years ago is with the rate that you'll pay for life. But inflation is a thing, right? So what I'll do when I go to these facilities is say, okay, we got AAA storage over here renting a 10 by 10 for $50, but all the competitors are 100% full and their 10 by 10 is $150 as opposed to $50. So I have the opportunity to come in, and the day I buy the facility, I'll raise my rents to the lowest in the town, but just below the lowest, right? So let's say the lowest is 150, I'll raise it to 145. So even if you want to move out, even though I just tripled your rent, I'm still cheaper than everyone else in like a 5 to 10 mile driving radius from our facility. Okay.
There you go. Yeah.
So that's number one. You can also add additional profit centers that a lot of these mom and pop operators are not doing, like car storage, RV storage, boats. You could sell locks, renter's insurance, which we make mandatory on every one of our facilities, moving supplies, packing supplies, cell towers, billboards. I mean, the list goes on, right? Propane, private mailboxes, ATMs. So all these other ways to increase revenue. On the expense side, there's also a bunch of things we can do, not only leveraging technology, but just running it like a business. I always tell this story because it's so funny to me and people think I'm joking, but there was a facility that we were underwriting where there was a $500 a month TV cost. And I was like, there's no way they're paying for like a TV service. This must be like a part of their internet bill or whatever, which also is too much. Right. Turns out, no, they were paying for a full cable package for their manager so that he can watch TV on the job. And I was like, this is $6,000 a year divided by, let's just say, a 7% cap rate. This is a massive amount of value that you're leaving on the table that day one, I come over and I just cancel the TV subscription, right? It's just gone. Because first of all, if you have nothing better to do than to watch TV when you're on the job, then maybe I need to limit your hours or find other things for you to do as a manager at the facility. Okay. Yeah. So there's another reason. We also have management softwares now that do a lot of things for us. They automatically text tenants when they're late. They automatically overlock units when someone hasn't paid in a certain amount of days. This is all stuff that would take manpower that we don't actually have to pay for anymore. It just gets done automatically with a very light package. You can expand a facility. So say it comes with land, you can throw additional units out, even if they're permanent structures or non-permanent structures. You can have these mobile units that you can move with forklifts. So there's all these different ways that you can, obviously there's two ways to make money. It's either you increase revenue or you drop expenses, or a combination of the two.
Yeah. Okay. Fantastic. I'll tell you what, I got a couple more questions, but before I go there, why don't we let us know how the audience can find more about you? Give us the insight if they want to invest.
Yeah, so I'll give you kind of two ways. So if you're more of a kind of like passive style person, you can go to our website, which is SSE.com. So SSE.com. You can follow our social media, which is the same thing, SSE or Self-Storage Syndicated Equities. You can follow me on social media at The Storage Stud, I believe is my handle on all the channels there. Or if you're somebody that likes to be a little bit more action taker and do things kind of immediately, you can just text me. I'll give you my cell phone number. It's area code 630-408-8090. It's my real number. You can text or call me anytime. I love to talk to new people about the industry. So easiest ways to get a hold of us.
Well, you've shared a ton of information just on this little 45 minutes that we've been together. So I may have to have you on again here in the future to do a part 2, but really interesting and appreciate that. How about as far as maybe a new investor, any recommendations, any advice that you could give somebody who's maybe just starting out?
Yeah, I always tell people the number one step is always to get educated about the asset class. So, there's a bunch of free resources online. You can also go to one of these trade shows. They have really great education tracks and they're not too expensive. I think the trade show ticket's like $500 for 3 or 4 days. And they have 4 days of like 8 hours of classes that you can take included in that cost, especially ISS. Inside Self-Storage World Expo is a really good one. The National Self-Storage Association Conference is another great one. Both of those also have a lot of free information on their websites if you want to go check it out. If you shoot me an email or shoot me a text, I can also send you, it's put together like a little accelerator video series of like 8 videos that go through each piece of a self-storage transaction, from marketing to underwriting, doing acquisitions, syndicating, building, selling on the back end. I could send that to you for free. Everything we do on the education side is free. We don't charge for any of it. We just don't believe in that. So that's another easy way that you can get educated without having to spend any, obviously you got to spend time, but without spending any dollars out of your pocket.
Great. And then one other question would just be, how about any book recommendations?
I have so many. I have over 300 books on my Audible account right now. So tailor down for me. What kind of books you thinking about? And I can steer it the right way.
Yeah, good question. Maybe something on, you already mentioned Traction with Gino Wickman, but maybe something from mindset standpoint.
Yeah. Really love Never Split the Difference by Chris Voss. Mm-hmm. It's kind of a negotiating book, but really it's more a book about active listening and being a better partner on all parts of your life, right? Not only business, but with friends and family, significant others. I read it once a year just to refresh it. That's one of my favorite books of all time. On the personal side, I really love Vagabonding by Rolf Potts, The Forgotten Art of Long-Term World Travel. I just spent 7 months in Brazil. Next week, I leave for Europe, one-way ticket. And, really good if you want to figure out a way to work while traveling.
Wow.
Really good book for that.
I have not heard that one. I will go ahead and that'll be next on my Audible. So, okay, cool. Yeah. Well, hey, I really appreciate it, Fernando. And like I say, I think you've brought some tremendous value to the audience. Obviously people can dig in and find out more on different ways of being contacted. So thank you so much for spending time with me.
Having me, Keith. Hey. Thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.